So Giovanni brings me a lot of great memories of my hedge fund trading days when we were trading Euro 5-year forwards versus Polish 5-year forwards on a spread. And we'd use the Fibonacci's and the Tom DeMark sequential analysis for trend exhaustion and mean reversion. So kind of poetry and math. Yeah, we love that stuff. Okay, let me go forward. This is nothing that we're about to say today. Yes, nothing that we're going to say today is trade advice or in any way investment advice. Please consult your financial advisors before you do anything in the Bitcoin markets. They are volatile, and we appreciate that. And let me get this, maybe I have to flip it over this way. Oh, there we go. Okay, there we go. Yeah. So we made a little video to kind of talk about where we've been, where we are, and where we think we're going. Okay, so that was a little longer, but and we didn't rehearse it, so we didn't get the lights down and all that good stuff in the stereo. But the kind of two stories I wanted to walk you through today. And the first one is about how we got Bitcoin into the pensions in the US. And I know there's a lot of people in the audience here that are kind of now looking at how do we get Bitcoin into the European pensions, the UK pensions. So when I was CIO of Santa Clara, the VTA, we were the first US pension to put Bitcoin on the balance sheet. And it was a long process. It was probably about 18 months. And, whoop, gotta go forward there. Probably about 18 months to get that going. And it was about 6 runs at the gauntlet. It was not an easy process. And there was a lot of learnings along the way. And the second story I want to talk about is why I think there's actually an even more attractive investment than Bitcoin, which is now are the Bitcoin treasuries. Okay, so those are kind of the two things we want to look at. So if we think about the kind of the evolution of the ecosystem, it started with the cypherpunks and libertarians and the developers and technologists. And I kind of look at that as kind of really the first big phase. And then the retail and institutional is kind of like the second big phase. And then now where we are, where you're seeing corporations and nation states that are entering the picture. is kind of the third phase. And we're still working on institutional, but I think those two kind of blend together. So in 2019, I got the idea that, hey, if we could get an allocation of 1 to 3% into the pension funds, we could wipe out the unfunded liabilities, completely wipe them out. At that time, Bitcoin was at $7,000. And of course, you know, everybody's like, well, geez, Bitcoin's had a heck of a run. You know, it's got to be at the top and at the highs, blah, blah, blah. And so we actually used Metcalfe's law, which I think Giovanni was just referencing, to kind of try to illustrate it, and we'll get to that in a little bit. So what we ended up doing, my philosophy was really, let's try to get them off zero. That's the first mission, to use the Anthony Pompliano, hype cycle there. Let's get them off zero, and if we can just get a toe in the water, we can get the conversation started. We can start learning more and more about this space. And so I started bringing in a lot of the different, kind of Bitcoin notable investors and what have you, like Dan Moorhead and different fellows. And we just kind of, every quarter, we'd have somebody come in and talk a little bit about what we could do to get the pensions in. And so we had this session in 2022, and I put it up there because I was looking for a photo of the actual crowd, but the crowd was definitely smaller than this. We had just gotten it done. We were going in there to talk a little bit about how we got it done, and there was maybe 50 people, I'd say. And in 2025, they invited us back. They're like, geez, this actually in hindsight wasn't such a bad idea, and worked out reasonably well. And we'd love to hear more about it and get an update on what's going on with Bitcoin, and where do you think it is today in terms of getting this into the pension funds. And so we did the same conference. We had about 650 people attend that session. Pretty much everybody there. It was just standing room only at this conference. We had 35 questions that came up from the audience. And if you've ever been to a pension conference, and this is the largest pension fund conference in the state of California. Every California pension's there. CalPERS, CalSTRS, all the counties, everybody. And they're normally at pension conference, you don't get a whole lot of questions because the trustees and those folks are kind of, they don't want to look like they don't know what they're doing, right? So it was super interesting to see the turnout and the change in sentiment. So I think for everybody in the room that is, looking for that sovereign wealth money, looking for the pension money, looking for the endowments and foundations, I think, we can definitely say from our experience having done it and still doing it, that the sentiment has changed a lot. So if you go back to 2019, when we started talking about this, it was basically the idea of an inflation hedge, and the idea that money printing had been going on since 2009, and we really tried to pitch it that this should go in our inflation bucket, and we just put a little smidge in there. It's got great characteristics. Everybody understands, the similarities to digital gold and gold, and so this just shows with the money supply, and then of course the set static number of 21 million bitcoins. If we go to the next one, this just kind of shows the correlation between the M2 and the price of Bitcoin, so global M2. And so, with the pension crowd, you're going to lose half the audience when you start talking about M2. But if you go into kind of the gold analogy and start talking about the devaluation of your purchasing power, it brings it a little bit back home for them. So I would definitely include slides on that stuff. So if you go back to 125 years, you can see that the dollar has lost approximately 98% of its purchasing power, which is pretty rough, right? And now when we were there in 2025 at the conference, we said, geez, people were like, oh, is that right? Is that possible? And we said, well, think about it. How much purchasing power have you lost since the pandemic? 20, 25%, right? And you feel it when you go to the grocery store. You're buying milk, you're buying eggs. I paid $8 for eggs now. $9 for milk. So if you kind of frame it with these kind of permanent capital type vehicles, that you have this analogy with gold, you can kind of make the case that, well, if you have a belief that Bitcoin and gold share kind of three main characteristics, you can't counterfeit it, it's limited supply, right? And you can convert it into fiat anywhere in the world, right? You can take a Bitcoin, convert it in Japan into yen, or over here in Swiss francs, same thing with gold. So if you have a gold bug or two on your board, this becomes a very powerful chart because they can kind of relate to that. And then they're like, oh, geez, it's like 1/10 the market cap of gold. You know, there's like, this thing could actually 10x. Maybe Sean doesn't, you know, isn't smoking something. And this chart kind of leads into the next question of, well, you know, are we too late, right? This was the question we kept running into in 2019, 2020, 2021. You know, geez, this thing's on fire, you know, it's so big, blah, blah, blah. You know, we must be too late. We missed the boat. And so I love this chart. This chart, the little orange dot, is the market cap of Bitcoin versus all these other asset classes, right? So, I mean, money at, you know, if we look at the global money supply, 120 trillion. A lot of room to grow, right? So when people can see that information visually, I think it's a huge help for them. So, of course, it all does come down to the numbers. So now you got to talk to the consultants, NAPC, Makita, Callan, all the consultant folks. I don't know who they use over here in Europe, Cartwright maybe. And you got to get them on board. Well, you know, that middle part there, the down 75% max drawdown, is a big limiter. That's right. So now it comes into position sizing, how much can we handle this, et cetera. Well, on the left, you got the expected returns, the compounded annual growth rate, what we've seen historically. This is through like March, I think, of 2025. Got to get this updated. But if you look at the far right, you have your risk-adjusted returns. And so a lot of people like to look at the Sharpe ratio and, you know, get excited about that. I always actually really prefer to look at the Sortino ratio, okay? Because, you know, I don't want to penalize my investment allocation because of upside volatility. And that's what the Sharpe ratio does. The Sortino ratio is more risk-based, downside volatility. So when you look at that and you have a 2.42 Sortino versus a 1.1 on the S&P, it's almost becoming a fiduciary duty to take a hard look at this investment. If you're not looking at it, you're putting yourself at fiduciary liabilities. And so I used to always try to point that out to the board. I'm like, hey, you know, right now everybody's like, oh, you know, we can't get into Bitcoin, but, you know, 3 or 4 more years when they're looking back, they're going to be asking you, why weren't we in Bitcoin? And that's where you open up yourself to a little liability. So when you're putting a portfolio together, when you're constructing a portfolio, it's kind of like baking a cake, right? You have a little bit of sugar, a little bit of salt, a little bit of flour, a little bit of yeast. Maybe individually they don't taste that great, but when you mix them in the right combinations, you get a beautiful cake. And that's how I always thought about our portfolio construction. And if you look at this chart, the chart on the right shows you that you have a fat right tail, which basically, if you're looking at the orange-colored bars, that's the return on Bitcoin. And then the blue bars are the S&P 500. And you can see how it skews very heavily to the right. So that's like magic in portfolio construction. Okay, so you got to get that into the portfolio. The second piece that's very important is the correlation to other assets. We want something that's going to zig when other things are zagging and hopefully, you know, offset. And you still have a very low correlation with Bitcoin. So there's a very strong positive case that you can make for adding this to the portfolios. So when we formulated our recommendation, the question that we kept getting from all the trustees and board members was, geez, you know, the 70 plus, you know, 80% drawdown. So like, you know, how can we size this thing? And so we said, look, if we went through the Monte Carlo simulations, the mean variance optimized portfolio, you could go from about 1 to 3 pretty comfortably without really crazily increasing the risk of the portfolio. Once you got to about 5, it was really starting the tail wagging the dog. So we said we thought we could do 1 to 3%. If we could get into 2, and if we were right that this thing has 10 times upside from where we are today, then unfunded liability of 20-25% is gone, right? So for the taxpayer, this is a huge thing and needs to get a lot more attention. I always say in California, you know, we pray for the taxpayer because in the California Constitution, you cannot cut benefits on pensions. And they are severely underfunded. So they really need Bitcoin. And there's a candidate that was running for the CalPERS board, Don Bay, who's coming, I think, to Plan B tomorrow, who I think I'll be supporting because he was fighting that fight and trying to bring Bitcoin to the pensions as well. Oh, let me go back one. Actually, so the point of this chart is as the market cap's going up, the volatility is going down, right? So, we don't necessarily want to look in a rearview mirror the whole time. We do want to be also looking forward and trying to make projections. So going back to Giovanni's point earlier, I wish I had access to Giovanni in 2019, because if I had brought in a mathematician to make this story instead of hedge fund guy, I might have gotten a little quicker resolution to my request. But this is it. So we're sitting in the Silicon Valley. Everybody in the Silicon Valley understands the Metcalfe's law, because we've all seen Instagram and Facebook and Twitter, and that's how you value these companies when they were all still public. I guess Instagram's no longer public, but basically what Giovanni was saying, if you have two people on the network, it's worth 4, right? It's the square. If you have 3 people, it's worth 9. If it's 4 people, it's 16, et cetera. So looking at the users and the active users on the Bitcoin network, you could pretty easily project out to a $200,000 price, even back in like 2019. So, we were trying to make that case to the investors that, this is actually pretty sound from an out, because you have to give them some kind of math that they can rely on, that if they did have a lawsuit from a beneficiaries group, that, hey, we actually did our homework and thought it through, right? So 5 years later, in November of 2024, BlackRock comes out and says, hey, 2%. That's what you should have in your portfolio. Gives you the same volatility as a Mag 7 stock. So that was great. Now when you have BlackRock coming out, and then last month, Morgan Stanley, somewhere between 2 and 4%. So obviously the sentiment is changing in the US. We saw it when we went to the pensions. We are seeing more people show up for these meetings. We were getting great questions. When Adam and I were talking about this, we were saying this is kind of questions you would have gotten in 2014, 2015 from most people that would be in this type of crowd here. But they're at least asking those questions, even though they're maybe 10 years behind. So we're getting there, right? So that's good. So that brings me to the next piece. So if we think Bitcoin's strong, and we do, Giovanni kind of laid it out for us. The upside in the future for Bitcoin is very bright. Well, what about a Bitcoin treasury? What's the point of a Bitcoin treasury? Why do you bother going public, and why do you want to deal with Sarbanes-Oxley and all these rules and regulations? Well, it's to access low-cost capital, right? If you get public shares on NYSE or NASDAQ or what have you, you have access to the debt markets, you start to build out a flywheel, which we'll come to a little later. So my job at BSTR is to buttress the OGs. They have their strategy, their ideas have worked extremely well for them, and so I'm trying to really buttress their efforts to make sure that we are executing on the strategy. So if we look at this phenomenon of the treasuries, we've all been watching it. Of course, it all starts with strategy, I would say, really, more than riot, but strategy. And then Marathon as well, very early. Of course, Metaplanet has been coming up really strong. And we do think that in this space, you're going to have regional winners. And in Asia, Metaplanet looks like they've got the top seat, right? MicroStrategy's got one of the top seats. We, being from the Silicon Valley, we think it's a handful of winners, just like it is with search and Google or retail and Amazon or Facebook and social, right? Or Twitter maybe is a close second. That you're going to have a couple winners that are going to eat up most of the pie. So when we're looking at our position, we're thinking about how do we differentiate? How do we compete against MicroStrategy? He's invented the playbook, and he's done an amazing job. So when we came out in July that we were doing this treasury, we said, okay, we're going to be an actively managed treasury. We had been doing a lot of work on what we could do to generate yield, what we could do to generate alpha, and we said, we think we could apply this to a treasury environment. We were going to do it in the form of hedge funds originally, and then we thought, actually, it's probably more efficient to do it this way. So the thing that we found when you look back at these markets, it reminds me a lot of the junk bond markets in the late 70s. Very inefficient. very new, and there's a chance here to really kind of help shape these markets. We can see how fast things are changing in terms of, 9 months ago, we really didn't have a whole lot going on in Bitcoin treasuries. Today, we have quite a few of them that have hit the scene. But we think that BSTR can really be kind of a catalyst to kind of really help push forward the entire ecosystem by supporting yield-generating ideas, by supporting alpha-generating ideas, right? So when I say alpha, I'm thinking capital markets. How do we make the capital markets more efficient for Bitcoin? Why is there, a kink in the curve on options trading in Deribit, right? It should be a nice, smooth smile, but there's not necessarily enough capital playing in the game. So we think that by allocating more capital into those spaces, that we can improve the efficiency and therefore grow the market even bigger. So this is just going through some of the treasury companies that some of our founding team has been involved with, and they're pretty extensive. They're really kind of involved in a lot of different treasuries, which we think is a huge advantage for us because we have a lot of insights that come from the experience of working on these different treasuries. And I know the H100 guys are here, and we're super stoked to be working with them. So going to the nitty-gritty about the flywheel of a Bitcoin treasury. It's kind of a couple of different areas that you can tap into from the capital markets perspective. And I saved the original sheets at the back of this presentation to give you a sense of what they were expecting us to raise versus what we actually did raise, which was significantly more than what they thought. So you kind of have a couple of different things. You got your common equity fiat pipe, right? You can use an ATM once you're made your 12 months on the exchange. Convertible preferred, the only one that had done it before us was MicroStrategy. We got one of those done. Convertible note, that's really a really interesting low-cost form of capital. You can do these at 0, up 40. In our case, as a new issuer, I think it was 1 up 30. So, I mean, if I can borrow fiat at 1%, buy Bitcoin, I think I should be doing that all day. So our goal is to get big fast in this space and really step on the gas here in 2026 as we get through all the SEC approvals. Fingers crossed that the government does reopen soon. So when we came to Wall Street, we wanted to kind of flip the script on Wall Street. My background, I've been in hedge funds for 30 years, started at the Chicago Board of Trade when it was open outcry, and I'd be like, I'll sell you 500 at a quarter, and we'd have to confirm visually and make sure that we're on the same page. And so my wife says I'm like the oldest walking dinosaur in the financial markets. But when we went to Cantor, we said, let's do a Bitcoin in kind equity pipe. We had seen the H100 guys do it, the AltBG guys had done it over here in Europe. We thought we should bring that to the US. And so we got a little bit of resistance initially, but then they pretty quickly got excited about it as well. And so that's a great thing because that's the first one in the US. We're doing a Bitcoin in kind equity pipe in the US. And our goal is to get a Bitcoin in kind convertible note done in the US in the not too distant future as well. So how do you get a Bitcoin in kind equity pipe done? You can't go to Coinbase or an exchange and say, hey, I want to float this note and the Bitcoin's going to leave your exchange and convert into our equity shares. They're not going to be interested in that. You got to know where it is the Bitcoin is, right? A lot of it's been leaving the exchanges. It's held off exchange, right? So you got to know where it's at. And that's one of the, I think, the big edges that we have versus some of our competitors. The founding team at BSTR are some of the earliest adopters of Bitcoin in the ecosystem. And they know the players, and they have a lot of credibility with those players. So I think that's just a huge differentiator for us and them. Now, if we want to be the Berkshire Hathaway of Bitcoin, which we do, we want to be that company that is this kind of the next iteration. If you think about Berkshire, it's coal. It's railroads that move the coal. It's power utility companies that consume the coal. It's not very green. And we think that what we would like to build is the digital version of the Berkshire Hathaway. built on the Bitcoin rails. And we're going to talk about the idea of using your Bitcoin as an asset to generate returns. So when we were going through this, we thought, well, geez, there's a lot of different pieces here. You know, this is a relatively new area. Like we said, 9 months ago, this wasn't even on the plate, right, on the dinner menu. Now it is. There's a lot of learnings that can be helped, we can help other Treasury companies with, try to get them through the gauntlet a little quicker. Implementation's not easy, but we are happy in an open book to share our resources and what we've learned. From a capital standpoint, the yield and alpha, we think, are going to be really big differentiators. And we have, you know, kind of some of the standard programs that you would think of: options, writing strategies, lightning nodes, good things like that we want to help promote. And then on the alpha, like we were talking about earlier, capital markets type strategies to try to help speed up the flywheel of Bitcoin. We also think that there will be opportunities to acquire other companies and really run them like a wholly owned subsidiary, just like Berkshire Hathaway does. You know, you can access our cost of capital rather than the market cost of capital that you're accessing today, which is going to be a significant improvement, huge improvement to those companies. We're a friendly player. Everybody knows Adam. Everybody loves Adam. You know, I mean, you know, we're in Switzerland, and we seek to be the Switzerland of Bitcoin, right? The Swiss Bitcoin Treasury. We want to be that neutral player and help support the ecosystem. So we create this flywheel, and you know, this was got a little help from one of my interns on this sucker at like 11 o'clock. But the idea being, you know, we hit the capital markets, and we can do BTC-denominated issues, we can do fiat-denominated issues, and that flows into BSTR in one of these different buckets, and there'll be more buckets, right? We'll have senior floaters, you know, subordinated debt, et cetera, down the road. And then, you know, we take that capital, we roll it into our SMAs, and we're going to be using SMAs rather than funds because we need to have the control, you know, over the capital accounts. But there will be big enough SMAs that it will be worthwhile for fund managers that are sitting in the room to talk to us. Okay, so. And then it kind of just starts to create a flywheel. As we generate fiat or Bitcoin, and in that case, with the alpha and the yield funds, would be primarily Bitcoin, but we also plan to support other income funds like the Berglinda guys and other folks that are here with the regular income strategies. And then we can either, you know, with the cash fiat, we can either buy more Bitcoin, or we can use it for a cash component of a mergers and acquisition with some shares, or we can convert it into more income lending, right? The Bitcoin that we earn obviously stays in Bitcoin and grows in Bitcoin. And then as we're doing any new debt issuance or any new equity issuance, that all gets converted into Bitcoin immediately. Okay. So, you know, just to recap, tremendous alignment between our founding team and our investors. We are our own biggest shareholder. We are eating our cooking. You know, this was from our presentation at Cantor. So at that time, our investors that were coming into the deal were investing at the exact same terms as our founders, which I think was super attractive. Like Berkshire Hathaway, we have a long-term perspective. We are in this not for years. This is not a 4-year vesting cycle on options and we'll move on. This is multi-decade. This is probably going to be the last job for myself, Adam, and several others. So we're really trying to build out a juggernaut that will be a financial fortress, and it will be a publicly traded company with eventually, you know, publicly rated debt, what have you, and will be hopefully the preferred counterparty to any financial institution that wants to deal in Bitcoin. So this is just, I got 30 seconds, so I'll just run you through this just for fun. Oh, maybe they're cutting me off. So this is the convert. You know, when we were working with Cantor, they were saying, oh, if we could get 300 million done, that'd be amazing. And so we ended up taking in 500 million. We had a couple shoes, so a little bit over 500 there. On the convertible equity preferred, this was not even on the menu. I got to hand it to Nico for pushing Cantor that we really wanted to do this. And we ended up doing 350 million on the convertible preferred. So that was really great. And then let's go back over there. The fiat equity pipe. So they were thinking, hey, if you could get 150 million done, this is a home run. We ended up doing 400 million, on that piece. So we're very pleased with that. And then of course the risk factors for the lawyers. Keep that on the screen for a moment. Again, none of this is financial advice, and please consult your financial advisors for anything there. Okay, and that's pretty much it.